it seems like this was a beat on all fronts. What's your take on these numbers?
Well, I think the number basically confirms that the economic activities are normalizing, especially on the consumption front. We see from high-frequency data that retail sales and some travels, etc., that were hit during the COVID-19 are slowly coming back. So that's the biggest upside from September data. And also from production side, we simply see gradual recovery from the low early in the year. And I think there are three things going forward that's going to help the recovery. One is the cyclical picture, as I mentioned, that retail sales consumption are recovering, and the industrial output are resuming. And two is a positive global tech cycle that has been quite helpful for exports and high-tech industries. This year, so far this year, semiconductor sales globally has turned positive after a steep drop last year. So this is a positive for China and for Asian tech producers. And the third factor, I would say, importantly, if you look at the breakdowns, it's an acceleration of the industrial upgrade that is driving the recovery. You break down the industries a bit, you see that the new economy, i.e. the tech sector, the service sector, the investment have been expanding, and the so-called old economy, the construction-related heavy industrials and some of the traditional consumption sectors, the investment has not picked up as strongly. So the new and old, actually, the divergence is rising, and we think going forward, this is going to continue to be a theme after the COVID-19 because of the digitalization demand and the import substitution demand on the tech side and the consumption trend.
Let's talk about that consumption trend, because we've seen 5 months now where retail sales have contracted, and this is probably the first print we've seen all year where we are in positive territory. You say you're starting to see some of the high-frequency data look pretty positive, but is it still premature to say that this is a broad-based consumption recovery?
It's probably a little early to say it's broad-based, right? For instance, the catering, it will take longer to come back simply because of the nature of the shock. But as you see that people are slowly coming back to normal, in the sense that in the past they probably travel taking airplanes, for instance, go to a faraway town. Now they want to take vacation in nearby suburbs or nearby towns. So the travel is resuming, but the pattern is a little bit different than in the past. So I think it's going to take time to go back to normal as we used to have. But I'm not sure if the old normal is going to repeat itself anytime soon. But at an aggregate level, the activities are picking up. Yeah. And also, I think the e-commerce platform really helps. And in the past, some faraway towns, low-tier cities probably don't have as much access to some of the goods sold on the market. But after the COVID-19, e-commerce now accounts for more than 26% of overall retail sales, and that is up 6 percentage points in less than 6 months. So the reach of the products to the consumers is also wider. So I think it's going to take time, but the momentum is there.
Cui Li, it does look like investors are liking the latest data down. The CSI currently extending its gain to 0.3%. In terms of this growth momentum, isn't it true that this is the easy part of that recovery? From here, it will be more difficult. We talk about an improvement in retail sales, but it will remain lackluster perhaps till next year.
Yeah, I think that's a fair point. You have the first leg that is mostly normalization, right? Part of it is normalization. So you have a strong rebound and that already is happening. But I think there are, so going forward, the sequential pace is likely to slow down a bit, especially because this time around, the government has not rolled out a big stimulus package. So the policy support is there, but it's much more measured than in past cycles. So as I mentioned, I think there are organic growth drivers in the economy, and the drivers will add incrementally to the growth, but it's not going to be as fast as sequentially as fast as the last couple of quarters.
Is the economy good enough to address unemployment issues?
Well, I think it's going to take a bit of time to repair on the job front, because this time around the COVID hit the most on service sectors, right? So the service sectors are labor intensive, and the restaurants, etc., they are labor intensive. So I think the growth itself is one factor, but the structure of growth is more important. You need the expansion of services sector, to drive job growth, and I think the transition is towards that direction. But because of the COVID-19 aftermath, it's going to take time, and therefore I think in the near term, fiscal support still is necessary. Income support, and we're also talking about job trainings to move people into necessary areas to create jobs.
Right. So fiscal support is still needed. In terms of what policymakers can do from this, how they're going to react to this data, is it safe to say that we're reaching some type of normalization in policy? At what point do we have to see tightening?
I think tightening is probably not yet on the card right now. But I do think that policy is already in the process of normalization, especially on the monetary policy front. We see that since May, the PBOC started to hint normalization, and short-term interest rate has gone up, and also long-term interest rate, risk-free interest rate has gone up. So we are already in the process of normalizing monetary policy. But I think fiscal policy is going to take longer. As I mentioned, there is transitional issues. During the economic transition, there could be job market pressure. So the government necessarily needs to provide income subsidies and job trainings to support this transition. And also the growth picture is still, on the headline front, even though it's picking up, it probably is not considered as strong enough yet. So I think at least in the next few months, the fiscal policy on the infrastructure front will still be in place, and they will continue to roll out the projects to support the reflation of the economy. But I do think that the longer term picture is that the government is going to use fiscal policy mostly to support the transition rather than to stimulate the economy. And the monetary policy will gradually move back to normal, especially next year. So we are looking for rates to move slowly higher next year.
Is that why we're seeing this upward pressure on government bond yields right now, Cui Li, with the Chinese 10-year at around 3.14, 3.15 right now? Is this a sign of Chinese exceptionalism or just addressing the liquidity concerns that traders might have?
I think there are several things. Remember, 3 point something is the normal range before the COVID. So it's not extraordinarily high. It just says, number one, that the economy is moving back to normal. And underneath that economic growth, productivity is increasing or at least keeping solid. And therefore, that's a supportive fundamental factor to the equilibrium interest rate. And number two, policy mix in terms of monetary policy and fiscal policy is also supportive to the rates. The monetary policy is neutral or going back to neutral, but fiscal policy will be expansionary. And we have seen a lot of government bond issuance in the last few months. And from a supply side, that is also putting pressure on the interest rate. So I think it's a combination of solid economy, economic recovery, and also the policy choices that the government has made that is supporting the long-term rates.
Cui Li, what do you make of yuan strength? At what stage will that impact Chinese exports? And if you take a look at the options market, it's already suggesting that yuan strength will not persist.
Well, I think there will be volatilities, right? You can see that the government increasingly is tolerating some volatilities of the yuan rate. But I think long term, there are several things. Long term meaning the next few months or next year. One is China's own fundamentals. The trade surplus is actually quite healthy, despite all these concerns about trade war. Now, of course, the commodity prices are low, and also China's overseas traveling is declining this year, has declined this year. Both of these are helping on the current account front. So the fundamentals is supportive. And second, importantly, is the dollar trend. Dollar trend is, I think we are going to see several years of dollar decline because of the massive easing on the Fed front. So that's going to, drag dollar down in the next few years. Of course, near term, we wonder whether there will be more volatility, but long-term trend is coming down. So that is supportive to yuan. And third, importantly, the Chinese domestic rates are much higher than the global rates. Right, as I just mentioned, right. The long-term rates is 3% something. Globally, the U.S. rate is less than 1, much less than 1. So the gap has widened a lot this year. So we have seen that global asset allocation on the bond front, on the stock front, they are coming into China. So from a capital flow perspective, it also supports CNY. And on the trade-weighted basis, CNY rate is actually not that expensive yet, right? Because of the US dollar depreciation. So I do think there is more appreciation to go for CNY.